Hello, folks. Welcome to Pro Trader Strategies. My name is Eric Wilkinson, and this is Spotting the Trade. I'm going to get you folks what you need to know before you roll, and that talks about the economic data, how it impacts the overall markets with market analysis, and then maybe sprinkle in a little geopolitical fodder to round that all off, and finally talk about some option strategies we could implement into a portfolio based on the assumptions we come up with in this market analysis. So without further ado, let's get on with it. Don't forget to hit that, smash that like button for me. All right, so hope everybody had a great weekend. What happened over this weekend? Really not a whole lot's changed. Still seeing the insurgent with Russia, Ukraine. We are also seeing China and Taiwan still have those tensions. So really starting to see geopolitical tensions ramping up just about everywhere. We're going to see China start to really open up here. I think we're talking about shipping with folks out in Singapore. They were slowing down for a little bit. We were seeing some of those ships start to stack up, but now I think that that's starting to ebb a little bit. They're starting to free that up. Ships are starting to move again. Now, with that said, if we start seeing China start to ramp up here, folks, with the demand that we're seeing already in things like, let's say, crude oil. Let's just bring up a crude oil chart since we're talking. Crude oil cranking up to the 120s, all right, 125 easily achievable at this point because we aren't seeing the demand coming out of China at this point. If we do see demand really start to increase and we haven't increased the supply, which is something we are not doing right now, that is going to exacerbate this. Could we see $200 oil? Absolutely, if we aren't going to increase the supply, and we're going to continue to see this type of demand increase. All right, so watch your crude oil. That is going to really be driving what is going on in the overall markets right now, because if crude oil continues to climb, we're going to see other aspects of the economy start to suffer quickly, because I've talked about it time and time again. Higher oil prices destroys velocity and money. As we spend more money going into our tank, for instance, last time this year, maybe spending $30, $35 to fill up your tank, it's costing you $70, twice as much money. So if you think about it, every single person you look at is spending $30 a week more just going into that gas tank. That means that $30 not being spent elsewhere. That really hurts the economy. So we're going to be keeping our eyes on crude oil here. As for economic data, we did have a holiday yesterday, so it was obviously a pretty light day yesterday. Doesn't mean that across the pond we weren't getting anything. We got Chinese manufacturing numbers, the PMIs. Remember, I talk about how these are forward looking. Anything below 50 is contraction. They've been getting 50s or below 50. So it's not really surprising to see the manufacturing number coming in at below 50, albeit just slightly at 49.6. That is higher than what was expected at 49.1 and higher than the previous month's 47.7 or 47.4. So seeing these numbers increase, are they going to go above 50? That's expansion, right? Well, they're ratcheting very close to that. And that's where my thesis is coming from, with the demand coming from China for crude oil in the manufacturing sector. So that starts to increase. We're going to start seeing positive gains there and more demand coming from crude oil. The service sector for China came in at 47.8, expected to be 45.2. So again, nice beat on the headline numbers there for China. What's that going to do for us, though? I think it's going to start causing the equities to start rolling over a little bit here. Here in the United States, though, we got the consumer price index flash estimate out of the European region, 8.1. I mean, we're starting to get used to seeing those 8s in the handle there, despite the fact that we were expecting a little bit lower at 7.8. The flash core consumer price index, remember, that's going to strip out some of the more volatile aspects like food, energy, and alcohol. That came in at 3.8, expected to be 3.6. So all of the pricing indexes showing a little bit higher incremental increase there. That's even without the demand that we're seeing from crude oil, or the possible demand coming out of crude oil that driving those prices. That's going to really exacerbate inflation, folks, because everything we do is tied to energy and the consumption of that energy. So if we're moving food, we're using gas to move that. Remember, we didn't get the pipeline that would have really helped us lower overall infrastructure costs of transferring this crude oil So we're seeing those prices really start to leak into other aspects of the economy, whether it's something that needs to be transported, any types of goods and services that way. Bonds coming off as we're starting to see a little bit of disconnect between what the markets want the Fed to say and what the Fed are saying. The Fed's still continuing to be very hawkish on interest rates there. Gold futures, though, I would expect this market to really get a kick in the pants here. We're starting to see even more and more angst in the markets. I'm expecting to see higher inflation. That means that begets a higher price for gold futures there. And Bitcoin, I think that we're going to see some type of push to the upside if the markets really start to correct here across the board in equities. You can see we're getting an uptick in VIX, NASDAQ starting to make this little bit of a toppy type of pattern. Now, I was talking all last week looking for this higher, a higher high, which we're getting right now. Is it breaking that pattern? It sure feels like it at this point, but with an exacerbated move to the downside or any type of risk to the economy, I think we'll see that downside again, despite the fact that we've broken into a newer high here, breaking the lower low, lower high pattern that we were looking for last week to get broken. That breaks that bearish pattern. And one would expect that we would start wanting to migrate back into this area of volume and open interest. So we got a 50-day moving average lining up with the value area low. Those two will act as a resistance right now. So maybe a little bit of weakness. The thing to look for here is this 32 to let's call it 32,300 just to be safe there. But holding this Fibonacci is something that we're going to be looking for in the Dow Jones. E-mini S&Ps, again, broke that lower high. So that pattern is broken right now. Are we going to be able to hold on to it? If we start really rolling over again, the number to watch is that 38,000 here in the E-mini S&Ps this week for a hold on this pattern here. Seeing the weakness creep in overnight, not really surprising. Yesterday was a pretty quiet day across the board with the United States being quiet. Not really a whole lot of market action, just really wait and see. And today we're getting some follow through to the downside. So while last week we were waiting for some of these patterns to get broken, to get on board with some bullish ideas, I don't think that anything has really changed incrementally enough to make us start jumping on board with both hands anyway. It's a time to start layering in opportunities because there's always a bullish market somewhere. We can take advantage of some of those pullbacks in those underlyings that are starting to rebound a little bit before everything else. We talked about this with like EA Sports, the banks, all right? I think even casinos, when we get out of this, remember, we've been talking about the roaring 20s for quite some time. I thought it was going to come out of the pandemic. Well, we had a bit of a slowdown there in between, and that's kind of held off on that. What has that done? Built up a little bit more pent up a cabin fever, if you will. Now, one of the things we were talking about is the roaring 20s, everybody going out, getting out. Well, we saw this happen with Top Gun this weekend. If you thought that the folks going to the theater to watch a movie because they were afraid of the pandemic or getting sick from Corona, well, that's really not the case. As a matter of fact, Tom Cruise had his best opening ever, and it could possibly end up shaking out to be one of the best opening weekends for a movie on Labor Day weekend. So that said, folks are willing to get out there and put themselves into a room with other folks that could be sick, and we're kind of past that, it seems. So I think that the economy will start turning around. What does that beget? Higher prices for crude oil. If we're not going to increase that supply, that means inflation across the board is going to start rearing its ugly head. So we're going to be keeping our eyes out for that, see if that starts influencing the markets this week. And before you go, don't forget to smash that like button and subscribe with the little bell, folks, because the bell will let you know when I come in unannounced for like these spotting the trade videos. All right. Take care. And if you can't take that, weak sauce. There we go. Take it easy. Bye for now.